Welcome to the Deep Dive from Talk Tickers. We're the place where we cut through all that earnings call noise to, find the real story for you.
That's us.
And today, we're tackling AGCO, the big global agricultural equipment manufacturer.
Right. And look, on the surface, it's definitely a challenging market out there for ag equipment. No doubt about it.
For sure. But their latest earnings call, it has some really intriguing stuff happening underneath, things we really need to explore.
Exactly. So our mission today really is to get past those immediate headlines. We want to pull out the most important insights, the things that matter.
So you can get a quick handle on AGCO's performance, right? And their strategic direction, especially, like you said, navigating this tough global ag environment.
Yeah, we're looking for those fundamental shifts. What really explains why the company's doing what it's doing right now?
Okay, let's kick off. GAAP EPS came in at $4.22. Now, for those of you tracking this closely, it smashed consensus expectations by more than 3 times.
Yeah, smashed is the right word. A huge beat on the bottom line. And the adjusted EPS, also really strong, $1.35. That beat consensus by $0.27.
And that adjusted number often gives a clearer view, doesn't it, of the core operational health.
Absolutely. You strip out the one-offs, the unusual items, and seeing that strong adjusted number, it just signals how well they're, managing costs and focusing on the core business in what's a pretty difficult environment.
Totally agree. Now, revenue, it was down year over year 18.8%. Let's be clear on that.
Mm-hmm.
But it still hit $2.64 billion. And that actually beat analyst estimates by a good $136 million.
Which is interesting, right? That beat despite the year over year drop.
Yeah. And then margins.
Yeah.
Reported operating margin was 6.2%, but the adjusted operating margin, 8.3%. Pretty robust.
And that's what's fascinating, isn't it? Despite that top-line pressure, that decline, managing to hold that adjusted operating margin at 8.3%. It really speaks to that strategic focus they keep talking about.
The higher margin stuff?
Exactly. Higher margin areas. This feels like a structural shift, not just navigating the cycle. And then there's cash flow.
Ah, yes. Free cash flow.
Yeah.
Positive $63 million.
Which is a massive swing. About $390 million better compared to the same time last year when they actually had a cash outflow.
Wow. Okay. That's a turnaround.
A huge turnaround. And you saw it in the market reaction too, right? Investors responded very positively. It showed real confidence, I think, in their ability to execute even now. Okay, so those numbers definitely paint a picture of resilience. But the big question for you listening is probably how. How are they pulling this off when the market's so tough? Yeah, the how is key. The CEO, Eric Hansotia, he kind of hinted at it. He said AGCO's 3 high-margin growth levers, that's Fendt expansion, precision ag, and global parts, they're delivering despite softer tractor demand. So it sounds like a plan. Oh, it's absolutely a plan, a very deliberate one. And if you connect the dots, what you're seeing is AGCO making this really intentional, accelerating pivot. They're moving towards being a software-rich, higher-margin ag technology company. Not just equipment. Not just equipment. Yeah. And that PTx Trimble joint venture they just closed, the $2 billion one, that's absolutely crucial. Crucial how? Well, it's not just an acquisition, right? It's a fundamental piece that's already starting to bring in recurring subscription revenue. And that kind of revenue is gold. It's what helps sustain that 8.3% adjusted operating margin, even when their traditional tractor sales volumes fell by double digits. So it really isn't just about selling more tractors then, is it? It feels like AGCO's strategically repositioning, like transforming its actual identity from, old school equipment maker to something else. That's exactly the deep dive insight here. You've nailed it. It's not just a pivot. It's almost a reimagining of the business. The market often looks at AGCO through that old lens, right? Cyclical industrial manufacturing. Upcycle, downcycle. Exactly. But the real story, the insight, is that they're building maybe an ag tech pure play kind of disguised as a tractor company. That PTx Trimble JV, the retrofit first idea we'll get to. These aren't just bolt-ons. They're becoming the engine of a new model. Higher margins, recurring revenue. Okay, fascinating. And it's not just the huge JV deals either. You mentioned their farmer core strategy. Yeah. What exactly is that, and how does that help them, capture more of the farmer's wallet? Right, Farmer Core. Think of it as their way of digitizing the whole customer experience, end to end. It brings together all their digital tools. Like what kind of tools? Well, things like online configurators, so farmers can basically custom build their equipment online. E-commerce for parts and services, and they mentioned that's one of their fastest growing businesses right now. Okay. They're even using AI chatbots for dealer support, getting answers faster. And they're physically transforming the distribution network too. 25 new store formats last year, over 140 new service trucks out on the road.
So the goal is to be essential after the sale, not just sell the machine and move on.
Precisely. Turn that one-time transaction into an ongoing relationship. That naturally boosts profitability through services, parts, subscriptions, makes them stickier.
Okay, makes sense. Let's shift to the outlook, financial guidance and capital allocation. Because, remarkably, AGCO actually raised its full year 2025 guidance.
Yeah, they did, which is pretty bullish in this climate.
Net sales revised up, now expected around $9.8 billion, up from $9.6 billion previously. Adjusted EPS raised to a range of $4.75 to $5. That's up from $4 to $4.50.
Big jump.
And the adjusted operating margin expected around 7.5%. That's hitting the top end of their old range.
Yeah.
Strong signals.
Very strong. And this isn't just, wishful thinking. It's based on concrete actions they're taking, those production cuts they're working.
Yeah.
Dealer inventories are getting back in line.
Right sizing.
Exactly. And they're seeing real benefits from structural cost changes, cost-saving initiatives. Management was pretty explicit. They see 2025 as the bottom, the trough of this cycle.
Okay.
But here's the kicker. Their margin forecast now, at the supposed bottom, is about 350 basis points higher than where they were at the last trough back in 2016.
Wait, 350 basis points, so 3.5 percentage points higher margin at the bottom of the cycle.
Exactly. That's a huge structural improvement. It really shows how the business has fundamentally changed its profitability profile.
And adding to that confidence, they just announced a new $1 billion share buyback program. That's a pretty big commitment to returning cash to shareholders right now.
It is. And the story behind that is actually quite interesting, too. The reason they could announce this now, it was enabled by finally resolving that old TAFE agreement.
TAFE, what was that?
It was an older joint venture or licensing deal. Sorting it out freed up $260 million in cash for AGCO. But maybe just as importantly, it removed a long-standing headache, a distraction for management.
Okay, so it freed up cash and focus.
Right. And that allowed them to shift gears on capital return, move towards these buybacks, which, frankly, investors told them they preferred over the special variable dividends they'd done before.
Ah, interesting.
Yeah, so it shows real management conviction in their cash flow, gives them more flexibility. It's a clear positive for shareholders.
Okay, so AGCO's strategy seems solid. The execution's there. But like we said, no company lives in a bubble. What's the wider ag market actually doing? How are these headwinds hitting different places?
Well, globally, the big tractor market is definitely feeling it. Down in the low teens percentage-wise. If you look regionally, North America saw tractor sales fall 13% year over year. And the bigger, higher horsepower stuff, down even more steeply.
Okay. And Europe?
Western Europe, tractor sales dropped 12%. And that's actually the fourth year in a row the industry's been declining there. So, yeah, it's tough out there.
But I thought I heard a slightly different story about Brazil. Is that right?
Ah, yes, Brazil. This is where it gets interesting. Brazil was actually one of the first major markets to turn down a while back. But now, showing some early tentative signs of recovery. Tractor sales there were actually up 6% in the first half of the year.
Really?
Seems to be helped by favorable trade dynamics, strong exports for things like soy and corn. So, yeah, this regional difference is really important for understanding AGCO's overall picture. They're diversified.
Makes sense. What about those dealer inventories we talked about? How do they look across these regions? That's usually a good clue about future production, right?
It is, yeah. It's a key metric. North America, still elevated. They're sitting on around 9 months of supply. Their target's more like 6 months.
So too much inventory there.
Right. Which is why AGCO is still significantly underproducing compared to what's actually selling at retail in North America. And that's hitting their margins. In that region, they mentioned negative operating margins for North America because of it.
Ouch. Okay. What about elsewhere?
Better news elsewhere. Europe is pretty much near its target, just under 4 months of supply. And South America made good progress, actually hit their target of around 3 months. So they've been disciplined about clearing that channel inventory globally. It helped us explain the better overall margins despite lower volumes.
That discipline seems crucial. Okay, what about the farmers themselves? Any sense of their mood? Are they getting ready to buy again once these inventories clear out?
Well, the early order programs in North America, they don't fully open until mid-August, so it's still early days.
Yeah.
But the feedback so far It suggests maybe some cautious optimism.
Cautious optimism, like what?
Farmers are saying, look, the average age of the equipment fleet out there, it's getting older. And there's definitely a desire, a hunger for the new technology AGCO is offering.
Okay.
But they're waiting for a bit more certainty in the market before pulling the trigger. It's almost like, that pent-up demand is building. It could be a nice tailwind for AGCO down the road when conditions firm up.
Right, waiting for the right moment to upgrade.
God has it.
And speaking of new tech, innovation. AGCO keeps winning awards, right? They highlighted PTx Outrun.
Yeah, PTx Outrun, the world's only autonomous harvesting solution currently. Pretty cutting-edge stuff.
And the Fendt 620 Vario tractor, recognized for fuel efficiency.
Best-in-class fuel efficiency, yeah. And these aren't just, shiny objects. They tie directly into helping farmers be more profitable, more efficient.
How so? How does that connect to the bigger picture?
Well, think about the long-term trends. Global population growth, more demand for clean energy, always needing to get more yield from the same amount of land. These innovations address those fundamental needs.
Right.
And that retrofit first approach they have for precision ag, that's a really smart competitive advantage.
Retrofit first, meaning?
Meaning farmers don't necessarily need to buy a brand new tractor to get the benefits of precision ag tech. AGCO helps them upgrade their existing machinery. That's a powerful, cost-effective way for farmers to improve yields right now.
Okay. That makes a lot of sense. So looking ahead, what are the key things, the catalysts we should watch for AGCO?
I'd say keep an eye on a few things. One, the incremental synergies coming from that PTx Trimble integration. How much more value can they squeeze out? Two, updates on dealer inventory normalization, especially in North America.
Right. When does that get back to target?
Exactly. And three, maybe some potential major partnerships with other big equipment manufacturers, OEMs, on the autonomy side. Those kinds of things could really help AGCO's valuation start to close the gap with some of those more software-focused industrial companies. The market might start recognizing this transformation more explicitly.
A quick question on tariffs. Always a concern for global companies. How's AGCO handling that?
Yeah, they acknowledge tariffs definitely create uncertainty, both on the cost side and the demand side. But their approach isn't just to pass tariff costs directly onto specific products in specific markets.
Well, how then?
They manage pricing more strategically, kind of across their whole global portfolio, trying to maintain overall market balance and stay competitive everywhere, rather than just reacting item by item. It's a balancing act.
And what about those proposed changes to ag policy in Europe? Any impact there?
They mentioned it, but said it's still very early days for that proposal. And, farmer pushback on these things is pretty common. So the feeling is a balanced outcome is probably likely. It's something they're watching, but not a major near-term issue impacting the guidance right now.
Got it. Okay, so let's bring it all together. What does this all mean for you, the listener, trying to make sense of AGCO? This deep dive, it really shows a company, I think, navigating some serious industry headwinds pretty skillfully.
Yeah, skillfully is the word, demonstrating real resilience and that strategic foresight we talked about, leaning into those higher margin tech-driven areas.
So our sentiment is what? Cautiously bullish.
I'd say cautiously bullish, yeah. Despite the market downturn, you've got this strong cost discipline, that clear strategic shift to ag tech and shareholder-friendly moves like the buyback. It's positioning them well, even in a tough cycle.
And the market seems to agree, right? Their stock performance has been strong.
Very strong, actually. It's worth highlighting. AGCO's total return, up 3.6% last month, up 36% last quarter, and up an impressive 27% over the last year.
Wow. And how does that compare to the broader market, like the S&P 500?
Handily beats it. The S&P was roughly, plus 2% last month, plus 8% last quarter, and plus 20% year over year. So AGCO is significantly outperforming. That tells you something. It's not just surviving, it's strategically thriving relative to the market. And here's a thought to leave you with. Think about how this accelerating shift towards software and services, especially with PTx Trimble, really integrating now, and the focus on autonomy. How might that fundamentally change AGCO's business model, its resilience through cycles?
You mean, could it become less dependent on just selling tractors, less cyclical?
Exactly. Could it start behaving more like a high-growth tech company, just one that happens to operate in the ag sector? If the market starts seeing it that way, that could lead to a significant re-rating of the company's value. Something to mull over.
Definitely food for thought. Okay, now let's transition to our not financial advice segment. And we need to be super clear here. This is purely for fun, for entertainment, for sparking ideas.
Absolutely. Not financial advice. Please do your own research. Talk to a professional.
Always.
But If I were hypothetically pitching an outrageous but maybe plausible idea to an investment committee,
Okay, let's hear it.
I'd call it the ag tech disruptor, long. The idea is simple. You go long AGCO, but not because it's a cyclical equipment maker. You buy it because it's becoming a leader in ag software and robotics.
So betting on the transformation story.
Exactly. The market right now, I think, still values it based on those old equipment cycles, but that misses the power of PTx Trimble, that retrofit first strategy, the autonomy stuff like PTx Outrun.
Yeah.
This company is changing.
And the buyback adds to the conviction.
The $1 billion buyback, yeah, that signals management sees the deep value too. So the thesis is, as the market wakes up and starts giving AGCO more software-like multiples driven by that recurring revenue, the high-margin parts and services, that current valuation gap compared to other industrial software companies, it could close, maybe even aggressively.
Interesting. Okay, so that's the outrageous but plausible idea.
Just an idea for discussion.
Got it. So to wrap things up, AGCO delivered a really solid quarter. You see strong execution, that clear focus on the high-margin growth areas, and a smart capital plan rewarding shareholders. All happening while the market's pretty tough.
Yeah, this deep dive really illustrates how those strategic pivots combined with disciplined execution can actually lead to outperformance. You can get structural improvements in profitability even when the overall market tide is going out. It's about adaptability.
Well said. And one last time, folks. This deep dive is for informational purposes only. It is absolutely not financial advice.
Please do your own research. Consult with a qualified financial professional. Your investment decisions are your own.
We're always curious, though, about what you're curious about. What complex topics should we unpack next? Send us your sources. Let us know.
Yeah, let's go on another deep dive together soon.